Bank runs are the first sign that the Fed broke something. Peter Thiel still had $50 million in Silicon Valley Bank. Can't run them all. Prominent investors, founders fund. Among those that had warned about U.S. banks' risks ahead of its collapse, Peter Thiel said he had $50 million in Silicon Valley Bank when it went under, even after his venture fund warned portfolio companies that the tech-focused lender was at risk with the collapse of Silicon Valley Bank. Questions of potential bank runs spread among regional banks. I will explain how a bank typically fails later in this video. A veteran technology founder and investor was wildly blamed for precipitating in a wild bank run, in which depositors tried to pull $42 billion worth of cash within 24 hours. How can people pull out of the bank that fast? Why am I getting bullish about TLT again? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back, everyone, to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? ECB defies mounting banking strains with half-point rate rise. Decision shows central bank still sees tackling inflation as its priority. The European Central Bank raised interest rates by a half percentage point, pressing ahead with its fight against inflation despite concerns that this could exacerbate strains in the financial system. The ECB said in a statement that it would increase its key rate to 3%, to the highest level since 2008, while promising to provide liquidity support to the financial system if needed. The move follows consecutive half-point rate increases in February and December. Many investors had been betting that the ECB might unveil a smaller quarter-point rate increase on Thursday after last week's turmoil in the U.S. banking sector spread to Europe. The ECB's decision provides an early glimpse into how major central banks, including the Federal Reserve, might respond to recent signs of market distress that started with the collapse of the two largest U.S. banks last week. Both the Fed and Bank of England are set to hold their policy meetings next week. Investors have repriced policy rates and sovereign bond yields over the past week, signaling a rapid shift in expectations about the direction of future monetary policy. In a nod to market turmoil, the ECB said it is monitoring current market tensions closely and stands ready to respond as necessary. It said the euro area banking sector is resilient. with strong capital and liquidity positions. The ECB's policy toolkit is fully equipped to provide liquidity support to the euro area financial system if needed. The bank said. The decision to push ahead with its pre-announced plans suggests that the ECB, at least, still sees pushing down high and sticky inflation in the Eurozone as its priority. Even so, investors are betting that the recent bout of market turmoil could be a turning point for central banks, underscoring the risks of their most aggressive fight against inflation in decades. Analysis pointed to the lack of guidance in the statement as a signal that the central bank could shift to a less aggressive monetary policy. Even before the collapse of Silicon Valley Bank sent ripples across markets last week, ECB President Christine Lagarde was facing a tricky balancing act as the central bank tightened monetary policy to fight inflation. The ECB had to raise rates without causing a recession in the currency bloc and destabilizing its most indebted nation, whose borrowing costs have rocketed. Now she faces another parameter: the need to reassure investors that the currency bloc's major banks are stable. She is expected to stress at Thursday's press conference that the ECB is watching market developments closely and has the tools to intervene if necessary. European stock markets rallied on Thursday after Credit Suisse Group AG said it would borrow up to equivalent to $53.6 billion from the Swiss central bank to shore up its liquidity. European bank stocks had slumped by around 8% on Wednesday, according to a closely watched index. Credit Suisse shares declined by nearly 1/4, but were trading more than 20% higher on Thursday. The problems at Credit Suisse serve as a reminder that as interest rates rise, vulnerabilities are lurking in the financial system, said Neil Shearing, chief economist at Capital Economics. Key areas to monitor are smaller European banks and shadow banks, particularly open-ended funds, Mr. Shearing said. Central banks' rapid rate increases over the past year haven't just weighed on borrowing and economic growth. They have also depressed the value of the bond portfolios commercial banks had been holding, a toxic combination for some lenders. The ECB in particular has walked a narrow path, aiming to raise rates high enough to cool down inflation, but not so high that it suffocated a European economy weakened by Russia's war in Ukraine, or raised doubts about public debt sustainability in Italy, Greece, or Spain. These are among the reasons the ECB has lagged behind other central banks in raising rates. For now, business surveys point to weak growth in the Eurozone this year amid declining energy prices and government spending, and the reopening of China's economy. The Eurozone's economy could struggle later this year, particularly if heightened concerns around the banking sector weigh on lending, analysts say. Underlying inflation in the Eurozone increased to a fresh record of 5.6% in February. Even as the US, it declined to 5.5% for the same period. The Fed increased interest rates to a range between 4.5% and 4.75% last month, extending the fastest series of rate rises since the early 1980s. Many investors are now betting that the Fed could pause its rate increases next week. A sharp turnaround from only a week ago when they expected a half-point rate increase. Ms. Lagarde is expected to indicate she is less committed to further rate increases and pledge to make decisions meeting by meetings based on available data. Bank runs are problematic in today's financial system due to fractional reserve banking. Under this system, only a fraction of a bank deposits must be available for withdrawal. In this system, a bank only keeps a specific amount of cash on hand and creates loans from deposits it receives. However, in a bank run, many customers of a bank or financial institution withdraw their deposits simultaneously over concerns about the bank's solvency. As more people withdraw their funds, the probability of default increases, prompting a further withdrawal of deposits. Eventually, the bank's reserves are insufficient to cover the withdrawals, leading to failure. Here is a simplistic example. Bank A has $100 million in deposits and $100 million in collateral trading at par, face value. As the Fed hikes rates, the collateral value falls to $90 million. Again, this is not problematic as long as customers do not simultaneously demand all $100 million in deposits. If they do, there is a collateral shortfall of $10 million to cover demands. Further, the bank must recognize a $10 million loss and raise appropriate capital. Often, bank capital raises scare investors. How did that happen? Mobile banking. Individuals no longer have to drive to the bank and wait in line to withdraw their funds. It is as fast as opening an app on your phone and clicking a button. A $17 trillion deposit base is now on a hair trigger of consumers expecting instant liquidity. The real problem for the Fed is not just bank solvency, but instant liquidity. As you have seen this week, as more bank fails, TLT goes up for the safe haven bid. And here is my client collaboration book. It's already yours, Adversity Equals Success. Such an amazing book with such incredible authors. You are such a good boy for watching my video right till the end. Bye.